Hello friends, today's topic is Action Plan 3, BEPS Action Plan 3, which is related to strengthening controlled foreign company rules, which are CFC rules. In this topic, we will be studying what is the issue related to CFC, what are the OECD recommendations thereon to address the issue of CFC, and what are the corresponding India tax provisions related to CFC. So friends, action plan number 3, which is strengthen CFC rules. CFC is nothing but controlled foreign company. So first of all, let's understand what is the meaning of controlled foreign company. Let's take an example of Tata Group, wherein they are holding shares in a company, in a UK company. So holding company is in India, Tata Group, and subsidiary company is outside India, which is in UK. Now they have made investment in UK company, which is a subsidiary of the Indian company. They are not bringing dividend income in India, or you can say investment income and passive income. Investment income is interest income and dividend income, and passive income is nothing but rental income or royalty income. So such income is not brought by the Indian holding company, and the reason being the rate of tax on such investment income, passive income, the rate of tax, let's say dividend, is too high in India. So they are discouraged to bring back the investment amount, and what happens is this hampers the development of the country because the funds are invested outside India. They are not brought back by the holding company in India because the taxability rate is too high, or the holding company wants to defer the taxability of such investment income, of such passive income. This is what is the concept of controlled foreign company, meaning foreign company is controlled from the holding company, by the holding company, and they are not bringing back the investment income, passive income that they have earned outside India. So there is, in a way you can say, shifting of investment income and passive income to subsidiaries. Funds are parked over there, and from there is even a possibility that they are not brought back as interest or dividend, but a loan may be taken by the shareholders of the holding company, and this is how funds may be brought in. Meaning, funds may be brought in, but through different nature, through in cut start in different form altogether, which with cut start, which won't serve the purpose of bringing investment back to India. So this is controlled foreign company, and to counter this rule, to counter such practices, CFC rules has been recommended by OECD only to encourage holding companies to bring back the investment, or at times the CFC rules will straight away tax such investment income, such passive income in the hands of the holding company, even if the funds are not brought back in the holding company country. On your screen, Action Plan 3, Strengthening Controlled Foreign Company CFC Rules, wherein practices followed are shifting investment income, which is interest and dividend, and passive income, rentals, royalties, to subsidiaries in low tax or no tax jurisdictions. So the entire investment amount is being shifted to a tax haven country. Deferral of home country taxation, since such investment income are not being brought back to India, they are being deferred indefinitely, because in case of dividend, if you see, it depends upon entirely on the company, on the subsidiary company, whether they want to declare dividend or not. So it could be even today itself they can declare dividend, or there might be a case that after 5 years they are declaring dividend. So deferral of home country taxation. Through CFC rules, it is possible to tax income in the parent country, that is India in an example, even when the income is not repatriated. So CFC rules ensures that the parent country is able to tax such income, such investment income, such passive income. It is not a minimum standard. BEPS Action Plan 3 is not a minimum standard but a best practice standard. So, meaning it is not mandatory, and accordingly it is up to a country to adopt it. OECD has only recommended best practices that may be followed by a country. It is not mandatory in nature. Only because you can say practically what CFC rules are more concentrating on is working towards objective of other contracting state benefits. So here in an example, if the same benefit was for country outside India, for bringing back the investment in a country outside India, if there are CFC rules, then most of the countries are not inclined to work for the benefit of other contracting state. Let's take an example. If in this case CFC rules are to be brought in an example, India and UK. India is the holding company and UK is a subsidiary company. So if UK government wants to work for the benefit of Indian government, wherein CFC rules are encouraging UK government to encourage its subsidiary company to repatriate their funds. So here UK government will be not so inclined to implement CFC rules. That is why it is a minimum standard and not a best practice standard. OECD is not forcing government to implement the CFC rules only because of this reason. Because there is objection for countries, there is objection from countries to work towards the benefit of other contracting states. India chapter. What India has done regarding CFC rules. In India, there are no CFC rules as such. Since the practices are best practice, India has not implemented any CFC rules as on date. Previously, they have been part of DTC, Direct Tax Code. Direct Tax Code itself has not been implemented. There are many provisions which has been borrowed by the government from the Direct Tax Code into the Income Tax Act 1961, but CFC rules is one of the concept which is yet to be brought from DTC code to India Income Tax Act 1961. However, it is not that India has not adopted any of the measures to counter CFC. In order to encourage Indian holding company to bring back the funds in India, Section 115 BBD has been introduced, which provides a preferential tax treatment, a beneficial cut start, a beneficial tax rate of 15% if a dividend income is brought back by the Indian holding company. In normal circumstances, such dividend income would have been taxed at the rate of 25%, 30%. However, the rate has been effectively been reduced to 50%, which is 15%, 15% is the preferential tax rate which will be applicable if dividend income is brought back by the Indian holding company. So this is one of the incentives that Indian government has come up with to bring back investment in India. On your screen, no CFC rules in India as such. Section 115 BBD concessional tax rate of 15% on gross basis meaning no further deduction will be allowed, dividend will be taxable as is and no deductions will be allowed on the dividend income. Gross basis 15% on dividend received from a specified foreign company, that is a foreign company in which the Indian company holds 26 or more equity share capital of the company. Meaning Indian company is the holding company, or you can say holding majority of shares, which is more than 26%. 26% or more of the equity shares are held by the Indian company. Accordingly, from such foreign company, if you are bringing back dividends, if you are bringing back investments in the form of dividend, the same will be taxable at concessional tax rate of 15%. This is one of the incentives in line with CFC rules, which is brought under section 115 BBD. So friends, globally if we see, CFC concept is very much prevalent and many countries are implementing CFC rules only to bring back the investments into their respective country, which will help their cause. And as we have studied, as we have discussed, CFC rules are nothing but shifting of investment income and passive income from the holding company. There is long-term deferral of income in the way of dividends not being declared by the subsidiary company. And only to discourage such practices, CFC rules have been recommended by OECD. CFC rules are not mandatory, they are best practice standards. And in India, if you see, there are no CFC rules. However, Section 115 BBD has been implemented, has been introduced to address the issue of the address cut start to address the taxability of dividend income, which is taxed at concessional tax rate of 15% in the hands of the Indian company, which is holding 26% or more of the equity shares in a foreign company. This concludes action plan number 3, strengthening controlled foreign company, which is CFC rules. Thank you.